All right, ladies and gentlemen, on this July 24th, Monday, 2 days before the Fed comes back out again, I feel like it's almost like Punxsutawney Phil at this point. Is he going to lower rates, or is he going to keep them the same, or is he going to see a shadow? Anyway, we're here today with John Ingram from Prosperity Mortgage. John, you have to hit *6 on your phone to be unmutified to testify. All right? So as soon as you've done that,
I'm here. Thanks for having me.
There he is. All right. Well, thanks for being on. I really appreciate it. It's kind of an interesting time too, because the Fed comes out on Wednesday, don't they?
Yeah, it seems like we can't get away from them. It's all we've talked about for it feels like a year and a half, but yeah, another meeting and another increase coming. That's my answer. First of all, they're going up another 0.25% on Wednesday.
Yep. I don't understand it, but it's not your fault. I understand. You're not Jerome Powell. I understand. But it's almost crazy that they continue to do this, and inflation's come down a little bit. I don't know.
Significantly down from almost 9% down to, call it, in the last CPI reading, you were at 3. So yeah, 3.1. But it's tremendous progress in a very short period of time, and certainly achieving their publicly stated goal of getting inflation back under control. But with inflation, it's all about belief. It's kind of this ethereal, mystical thing where if people believe that inflation's going higher, it goes higher. And if you believe it's going lower, it's going to go lower. It's interesting that so sentiment really matters to them, and they are intent on sort of breaking the back of inflation, getting it back down to their target of close to 2%.
Right. At the expense of everything else. Unfortunately, that's the problem. The economy's tough and good, so it's weathering it, and the real estate's still clicking along. But a nice little, like you said, perception, a nice little perception. Even if they didn't raise it at all, or if they lowered it like a 0.25 point, it would send the market into a little bit of a spur, I think, which would be nice. Even though the stock market is up today, I don't know why the stock market's up, but normally when they start hinting of that. Probably because, I think the stock market's just said, hey, look, this is the way it's going to be for a while, and we're just going to keep trucking, and who cares?
Well, the stock market does what it does for many, many reasons, but certainly we're in earnings season right now where companies are announcing their second quarter results, and they've been strong. They've been really good results. Profitability has been holding in there. Sales projections for the remaining portion of the year is holding in strong. So we've had a strong market. It's been up 10 days in a row, basically.
Right.
Which is
it's within 5%.
Nice for those of us that have investments.
It's within 5% of the high.
The all-time high.
5 or 6% that's just a rough estimate based on what I just looked at really quick. So everything makes sense except what the Fed is doing. And to me, I like it to be mathematically sound, but it really makes no sense for them to continue to do that based on what's going on right now. So anyway, we can bitch about it all day.
How high do they need to go? How high do they need to go to get inflation to 2%? Right? They're not at 2% yet, and they want their influence to be restrictive enough to make sure that inflation gets to 2%. Getting to 3 is the game's not over for them. They're still trying to win the game, even though 3% feels so much better than nearly 9. And we can see the amount of progress. I certainly look at it from the outsider saying, how fast does it need to go down before you guys start taking some victory laps, right? And saying, oh yeah, we've done enough. We can wait this out. We've taken rates from 0 to 5.25%. And gosh, that's achieving our goal. They just keep stomping on the brake harder and harder, with the idea that they want to be certain that this car stops, right? The inflation actually gets to where they want it to be.
Yeah, I think you're right. I think that's I think if they level out too fast, then it'll climb again, and they don't want that to happen. It's just a show of how strong the economy is, and you would think
Agreed.
they would like that, but the job markets keeps looking good, and so that's bad because that means more people are spending, and they're trying to handicap slightly, just so it which is kind of weird. When's the last time in your history of your life that you said, "Oh, job market good, that's bad"? Spending is up. Oh, that's bad. I mean, it's weird.
Right.
It's a weird time.
Right.
But anyway.
Well,
it is what it is.
The last time we had to face inflation, right? But the idea that the labor market is so tight right now, it is so strong that that's an area that breeds inflation. And so while they will never publicly state it, I think they do want to see that labor market come back into balance, and if it comes back into balance, you're going to see a certain amount of layoffs in the world, and a little bit certainly much more difficulty in obtaining jobs. Whereas right now it's so easy at this point. There's 2 jobs available for every 1 worker who's looking for work, and
right.
So it's about matching that stuff up.
Yeah, technically the unemployment rate could be 0 right now. It's when you get down below 5, as the saying goes, it means everybody who wants a job currently has one.
Yeah, and I'd say in real life terms, you have to match people up. Like, there are jobs out there that I don't want to do, and so those jobs that are unfilled right now by the workers that we have are the ones that either they don't have the skills for, or they don't want those jobs, that sort of thing. That's where you need immigration and other things to kind of fill those gaps. Right.
So, all right. Well, and how? So let's hear it. How's the mortgage world going right now? How's that trudging
along? Volume way down, as we can all sort of see, as far as the number of units happening in real estate right now is significantly lower than where we were, but the sentiment is that those of us who make it through this time will be the winners on the other side, right? This is a moment in time you have to get through. Interest rates have been wobbling effectively in the upper 6s, low 7s, and continue to bounce around that range. We really need to get through the last of these increases from the Federal Reserve, and then we could potentially start talking about interest rates moving down significantly. The best experts in our industry are, and sort of the smart money out there in the street, they are all pointing towards you will see lower interest rates in the future. That prediction is, everybody's quite confident in. I personally believe we will, and I think we need to have our clients ready to take advantage of that. The thing that you have to kind of just deal with is getting through this moment of time and helping consumers or helping your clients to see the logic of this. And this is really one of my big messages for today. There's a certain gravity to the mortgages that we gave out over the last number of years. Where you have in I think the number is about 40% of all mortgages are less than 4%, and you have people who, smart people who are in those homes who might like to move, who might put their house up for sale, that are not willing to because they can't wrap their head around a logical reason to give up their 3% interest rate, their 3.5% interest rate, when interest rates right now are nearly 7 or even slightly above 7, depending on your scenario. There's a bigger picture to look at, and this is what I think our agents need to be having conversations. At least start this or open this door so they know to look through it. It's the idea that you have to look at your borrowing holistically. So many Americans have more debt than simply their mortgage. And if you're just looking at your finances and saying, my mortgage is 3%, I can't justify moving anywhere else, even though I really would like to, and that would make me happier in my life and so on. Well, look at the revolving debt that you have. Americans have, at this point, $1 trillion of revolving debt. That's credit card debt. They have auto loans. They have student loans. They have personal debt consolidation loans. There's all of this debt load that are at much higher interest rates than what you have on mortgages. And so when you're looking at your financial situation right now as a consumer and trying to decide, is this a smart sort of financial move in my life, you could look at it this way. If you own a home right now and you've owned it for a couple of years, you're a winner because and on average, you've built up significant equity in that home, right? We've had home prices have been going up for years. We had a small dip in the first quarter of this year, but now that has obviously, it has reversed direction, and we believe it's going to be heading up through the end of the year and into next year and that sort of thing. But anyways, you have all this equity. And so imagine what the power of that equity can do. It's if you were to sell your current home, take that equity and wipe out all your other obligations, wipe out that $75,000 of credit card debt or higher interest rate loans, this sort of thing, and then still have a sizable down payment for your new house. If you blend all your borrowing costs together for what you have now, your 3.5% mortgage, your 29% credit card, right? Your actual interest rate of the money you're borrowing might be 9%, right? It'll be something higher. And then if you look at the monthly payments that you're having to pay, it's, I'm paying $1,500 towards that other debt, and I have $2,000 for my house. All right, well, that's $3,500 a month there. How much will $3,500 a month get you, or $3,000 a month, or $2,500 a month get you on that new house? And if you look at it all that way, you may actually be moving financially. You may be moving forward financially if you look at it holistically and what you can do with the equity in your home to set your family and yourself on a better path. That's what people have to have sort of highlighted for them right now. And that's how you're going to help them to see, now is the right time for me to sell this house. And yes, it's financially justified for me to give up that 3.5% interest rate because of what it does. And then the real, one of the secret sort of or hidden benefits of all of this is that people, and there are many scenarios about this, and we can do this analysis for anybody individually, but if you look at this, if you take the total of all payments, let's say, you're at $5,000 a month going out in bills right now, but your new house payment's $3,000. Well, that $2,000 a month, if you pump that back into your mortgage, now you're debt-free credit card-wise and other auto loan-wise, and you're on a path to pay off your mortgage in 14 years instead of another 30, for example. That's the magnifier effect that you can use with even at the 7% interest rates.
Right.
So for me, it's an interesting thing that people are not, they have trouble seeing for themselves, and they need to look at that to say, what's my true borrowing cost for all of my obligations at this point?
That's a good point. Because, you could, and then, you have the higher interest rate, but you got the new property, and it's a two-step process because you can do a streamlined refi probably within 6 months, definitely within a year or so.
Absolutely. I mean, every client that we help right now, we're talking to them about that. Please be ready for your refinance opportunity, right? And while we can't guarantee it, we do expect that we can see that path coming. We think that in a very short period of time, you're going to see interest rates into the upper 5s, mid 5s. We think that, over, say, maybe the next 24 months, you're going to see interest rate into the 4s. And general rule of thumb says if you can improve your interest rate by 1%, it's mathematically worthwhile and will justify itself. If you can improve your interest rate more than that, wow, you can save yourself significant money. So yeah, everybody we're putting into a mortgage today, the house is what you're buying and what's permanent. The mortgage is just the tool you use to get it, and that is changeable and replaceable should the world give you a good opportunity going forward.
Yep, I agree, and I think somewhere in the mid 5s will spark this market into a little mayhem. far as transactional?
Oh gosh. I mean, the one big thing that's not changing is inventory, right? We don't have enough homes for sale. Population dynamics are saying that we're having more buyers come into this market than are going out of the market every year. And this is such to where those who are able to own real estate are going to benefit from that going forward. And it's not going to get cheaper. It's not going to get easier for you. You have to find your way into the game so that you can benefit from it. And the sooner we get you into home ownership, the better off you are.
Right. And if you do buy now, you said stay prepared. I think what you meant by that is stay prepared for that refi, meaning don't go buy a Ferrari, don't go buy,
Right.
all kinds of stuff on credit card. You just paid your credit cards off, hopefully. So keep it that way.
Yes. Right. Stay financially fit. Maybe, and this is a niche scenario, but all right, maybe now's not the time you change industries and start a new business, right? Don't leave your attorney job and go start a medical marijuana business, right? You don't need to do that right now. Do that after you've taken advantage of that change, right? That's one of the ways. But yeah, keep your credit in shape. Keep your income strong and going forward. Just keep your financial house tidy so that you can benefit from it, because no one can guarantee your ability to refinance. And most of these mortgages that we're giving out now will require you to re-qualify to be able to refinance. It's the government loans like FHA and VA have these reduced sort of criteria refinances where you don't have to go through as tight or as tough of an evaluation to make sure that you can refinance. But the conventional loans out there, you start fresh. You're going to have everything looked at just like you did when you bought the house.
Okay, cool. Yeah. All right, good. So there we go. There's the overall. You mentioned that the rates were in the high 6s and low 7s, kind of revolving around through there.
Yeah, it's
wobbling. I think you said something about. Yeah, and I think you mentioned we could see something in the high 5s within the next 12 months, and maybe even the 4s in the next 24, which I think is a safe bet. Especially we've got an election coming too, so that could have a big part of it. That could be a big part of that as well.
Yeah, very possibly. There are historical patterns that, for some reason, nobody can tell you in advance what's going to cause it to get there, but some circumstance causes it, and you end up with this pattern that reveals itself where interest rates improve around election time. The skeptical among us would say, yes, politicians like for that to happen, helps them to get elected.
Well, for the longest time, that's what I thought that they were doing, is raise the rate, kill inflation, and then slash the rate, spark a major real estate boom. But I don't know. The way they're going, it doesn't seem like that's their plan. It just seems like their only plan is to crush inflation at any expense, which is kind of crazy because then if you have, if you create a recession, then it's a problem.
Yeah, right. But we'll deal with that problem once it's here. We know that, and I can personally say the inflation that we've seen in the goods and services that I have to buy, I felt it, and it stinks. Inflation sucks for everybody. Excuse my language. You know what I mean? Yeah, that hurts everybody, and is really hardest on the low income segment of the country and those who are already on the edge, so to speak. So getting that under control, I'm all in favor of. I don't want to necessarily drive the economy to a point where we have layoffs and people have tough times, but dealing with inflation is a very valid goal in my mind. Yeah, no doubt. I mean, I go to Costco every other week, and my line is what used to cost me $275 for 2 weeks. All the stuff I buy in bulk is now $400, and it took a little while. It might even be, but it's gotten a little better. It's like $375 now. It got as high as like $425, but still, it's still 30 to 40% higher. And when inflation starts, it's like almost everybody jumps in and takes advantage of it. Right? That's what happens. They shrink the size and increase the price, and so that's where they're coming up with these numbers of inflation being so high. Yeah, and you know, that's certainly something that I think is at work here that hopefully we'll see break, but corporations have been able to, pass through the increased cost of making goods, but they've also passed through additional profit for themselves. And,
Right.
and at some level that you would hope would break, and they may have to say, all right, well, we took those additional profits for the time that we could, but we don't want to lose market share, so let's drop price back a little bit. Let's give up some of that profit so that we can sell more widget, you know, more cans of Coca-Cola or whatever it might be, instead of having our consumers substitute to other things. And that's something we haven't seen in a significant way, at least from the major sort of core companies that are out there. They're not talking about substitution effects yet, where people trade down to, let's say, from the name brand to the generic. We're not seeing that in the ways or at the levels you have seen in the past when the economy is really under effective pressure, where it's shrinking, where consumers are really stressed out. That substitution hasn't really come through yet in a significant way.
Right. No, I agree. Okay, cool. So anything else from the financial, especially from the mortgage part, anything else you can see that these guys should probably know?
That's a broad question. Let's think. As far as programs and such out there, I would say that there is always a continual push towards down payment assistance products, that sort of thing. Prosperity, our company did launch out a new down payment assistance program that does not have any income limits, doesn't require you to be a first-time home buyer, and so it casts a very broad net. There's no location limits, doesn't require you to have a certain employment background, so it's not exclusive to certain industries or anything like that. That's a nice tool to use for those people that might need a little help on the cash side. The core products are fairly steady, but getting tinkered with at all times. Like the rule makers have made the underwriting systems a little tighter. It seems when it comes to the qualifications and how the automated underwriting systems say yes or no. The niche products, the alternative products that are in the marketplace are pretty stable at the moment, where in times of stress, you need the products to disappear. So you're talking about the bank statement loans, the asset-based incomes, the DSCRs or investor cash flow loans, those sort of things. Those are fairly stable in the marketplace at this time, so you can get those with multiple options for that sort of segment, and it's holding steady there. That's kind of where
what about investor
at.
loans? What about the investor loans right now?
They're a popular product. I mean, the DSCR stuff is a really interesting niche. DSCR is debt service coverage ratio, which basically all it's talking about is the rent of the property is sufficient to cover the monthly cost of the property. And so in those type of products, rather than looking at your traditional tax returns and pay stubs and things like that, you're purely focused on does the property pay for itself or better, right? And if it does, then your traditional debt ratio is not analyzed. There's a ton more flexibility on the money side of things as far as where the dollars are coming from. You can own it a lot of times you can own the property inside an LLC if you wanted to. Different flexibilities come into place, but that's a really smart niche. One of the more powerful aspects is it's a great product for those people that, own 20 properties and have 5 different businesses. And it's a really time-consuming, complicated process to get them through the traditional underwriting of a loan. That DSCR product is I'm just going to give you is simple in a comparative way to qualify for and get a consumer into that loan. One of the key things I love to highlight for people is the fact that when you get those DSCR loans, they are a business purpose loan. They're not a residential mortgage like what we're used to. And as part of it, they are exempt from the normal sort of good mortgage rules where we prove that you can afford all of your bills plus the new mortgage, things like this. It doesn't follow those rules, and it would normally not be acceptable. But because it's only for a business, and you sign a certification when getting that loan that says, I promise to never live in this property. It's only for rental use, so long as this mortgage is on the property. That's a really interesting sort of take on how the industry has gotten around it. Like, and I kind of wandered there, but ultimately, this mortgage gets to break all the rules that normal mortgages do because you're saying you'll never live in the house.
Right.
And that's
what's the down payment for that one, John?
Limitation. It could be as little as 20%. I would say in the Vegas market, it's more commonly 25 or 30. And what the function is how much down payment do you need to do to get the rent to cover the house payment? That's the biggest driver. But generally, minimum is going to be 20%. If you've got something that has has super strong rents and will cover the cost of the mortgage at 20% down, wonderful. But what I see is when you get into the math, it's usually closer to 25 or 30% to make that work out.
Gotcha. Yeah, that sounds like a good loan. Yeah. And what's the interest rate on that baby?
I'd tell you mid-8.
Okay. So yeah, it's definitely a little bit more than residential, which is perfectly fine given the situation. Yeah. For sure.
There's a cost of it, right? But if everything else is no, and I'm just going to give you an example, that in the conventional world, once you reach 10 properties that are financed, you're kind of capped out. Conventional doesn't let you do it. FHA, no, this sort of thing, right? Whereas with these DSCR loans, you could have 50 properties that are all financed and still get that loan and get your next one and your next one and your next one. So it's a great tool for those with a portfolio. It's not going to be the first product you go to, but when you get to a really sophisticated scenario, this would be one. Like if I imagine trying to give a loan to Bill Gates, for example, let's say he wasn't going to take cash. His finances are super complicated, and he's going to have to pay his people in order to get me the documents they want. Like he's going to pay attorneys to provide documents, his CPAs to provide documents, all that kind of stuff. All that's avoided in that product, and is worth it at some level to some borrowers.
Gotcha. Perfect. All right, John. Well, listen, hey, we're right at time now, so I really appreciate you taking your time out this morning to get us educated up on the finance, the mortgage industry right now. As always, get your people pre-qualified through John or anybody at Prosperity Mortgage. And anything else you want to say, John?
No, I appreciate being invited today. So everybody expect interest rate or the Fed to raise interest rates Wednesday. It's not going to move mortgage rates in any significant way. We've already anticipated this. We know it's going to happen. Right now, the odds are they're going to raise again in September, and then maybe at that point be done. That's kind of what they've signaled to the marketplace. But they're looking at the data every month, and the data is showing better and better things for us to where they can take their foot off our neck eventually here. So that's kind of where you're at in the short term. So it's pretty stable.
Awesome, my man. Well, thank you very much for your time. Really appreciate it. You keep it rocking. Everybody else will do this again in a week. Thank you very much, John. Appreciate it.
All right. Take care, everybody.
You got it. Thank you.